Friends, this is a session we are recording and trying to bring you something on financial planning and how to do investments so that you can retire in a dignified way after 30 years. The whole idea of this session will be very, very fruitful for all those who are anywhere between 25 years to 55 years. I have been meeting my students, MBA students, who have then become alumni, and I meet corporate executives all the time. And I'm really appalled at the level of ignorance that people have. Even if they're aware of an instrument like say NPS, if you ask them, they don't have an account even if they're 40 years old. So this is a very genuine desire to do that. I also want to make you aware, Rajiv, that things are very difficult now. The environment has totally changed for the last 30 years. So what has happened is two things, as you know. We used to very comfortably get an interest rate of 14%, 12%, 25, 30 years back, and today the interest rate is going down, and it's down to 5% now, below 5%. So that means if your father had 1 crore rupees, he would have got an interest of 1 lakh rupees per month. And today you cannot even get 50,000 rupees per month. And then there is inflation. And then you can expect, with the kind of medical benefits coming up, you can definitely expect to live up to 85, 90. So just imagine, Rajiv, that if you have actually retired at 60 and you have to live up to 90, with that, you really need to build up a good investments base. This is the preface. I want to do it. I want to discuss a very interesting thing which you know already, Ajay. That is basically which Albert Einstein called the 8th wonder of the world, which is called the compound interest, the power of compounding. We have all studied that, but this is not a mathematics class. So I'm actually trying to tell you how to utilize the knowledge of compounding. I'll give a very simple example, which is, you can Google it and you can find it out. That if you invest a particular amount of money, right, at the rate of 10% for 5 years, it becomes 1.6 times. But if you keep the same amount of money for 50 years, it does not become, 16 times or 18 times or 30 times. It becomes 117 times. It is the huge, the impact it makes. So therefore, the lesson that we learn from this is that you need to keep your money for a long period of time. You should not draw from your investments. And the second very important thing is that if you invest at instruments which are a higher rate of interest, then the compounding effect will be much more. Just to give a simple example, if I give a simple thing for you to remember, if I got 15, 15, 15, that is rupees 15,000 invested per month at 15% for 15 years gives you 1 crore. But the same amount of money, 15,000 at 15% for 30 years, which is just the double the period, it does not give you, it gives you 10 crores. So you need, what's the lesson from this? And but this 15,000, if you put your hard-earned 15,000 rupees, if you keep it only for instruments at 3%, but give it 30 years, it will be less than 1 crore. So lesson number 2, Ajay, which is very important for us, is that you need to find out and put your hard-earned money into instruments which are going to give you higher rate of return. That's very, very important. And I meet executives and students and alumni all the time, 35, 40. There are a lot of new instruments which come about. I just mentioned about the National Pension Scheme. And then, of course, there's a stock market, there's a mutual fund. And today, your mother and grandmother used to buy gold in jewelry. But there's a lot of money buying and selling because the making charges all got based. Now you can buy gold in demat form. So the idea is, we are going to have a sequel. So I would request you to subscribe to this channel so that when you come up with the next one, you can actually be up to date. But I just want to touch upon this Sensex part a bit. I'm very bullish on India. And if you are bullish on India, then how to take advantage of this growing economy? Only by investing in the stock market, either directly or through the mutual funds. So after you've done your health insurance and medical insurance, you try and invest in the stock market, directly or indirectly, right? And imagine Pulama, if you could buy the Sensex stocks, the best 30 stocks with the same 1 lakh rupees, you're able to invest in the entire group of 30 stocks. And the thing shows that in Sensex stocks have given over 40 years 17%. And there's very little risk. So we are going to manage your risk. You do your medical insurance, health insurance, do the risk management properly, and that's what is the next session all are going to be about. Okay? So thank you so much for the introductory session. Okay? We hope you benefit from this.